So far, we have learned the purpose of the cash flow statement, how to break it down to distinguish cash flow from operating, investing, and financing activities, and how to calculate it using the direct and indirect methods. We have made great progress, and this lesson is really the last piece of the puzzle. Our task is to calculate a company's cash flow using the indirect method. On the left side of the sheet, we can see the calculation of the firm's cash flow for last year. What do you need to calculate its cash flow for this year? You already know the answer, don't you? You need the company's income statement and balance sheet for the current year. We can find the two statements on separate sheets in the file that is opened. Please note that the cash flow calculation we will perform starts from EBITDA and then subtracts taxes and interest expenses. We are omitting D&A on purpose, as it is a non-cash expense. I will simply link these three values to the income statement sheet. Here we go. Let's move forward. Next, we will have to calculate the movements arising from the three working capital components: accounts receivable, inventory, and trade payables. The logic for calculating cash movements of assets and liabilities is as follows. If an asset increased, there was a cash outflow, we paid money to buy the asset. If an asset decreased, there was a cash inflow, we received money for selling the asset. If a liability increased, there was a cash inflow. We took debt or financing and money came in. If a liability decreased, there was a cash outflow, we repaid debt and therefore spent money. This is a good logic that explains the rationale behind cash flow calculation. It is useful to remember it. You'll need it whenever you have to construct or analyze a cash flow statement. The minus sign in front of the two asset components ensures this logic will be respected in our case. And here is the cash movement for the inventory. This is an asset, which is why I'm putting a minus before the brackets and subtracting 2016 inventories from 2015 inventories. Let's copy the same formula for the row below, as trade receivables stand exactly below inventory in the BS sheet, and the same formula is applied to them as they are an asset. Next, we have trade payables. They are a liability, and their increase generates cash. Hence, we would not put a minus sign in front of the formula that calculates cash movements for liabilities. We are subtracting the amount of trade payables at the end of 2016 and the amount at the end of 2015. These three movements represent the amount of working capital that the company operates with. Next, we have to calculate the cash movements of other assets and liabilities. We have the same thing as above. The other assets movement has a minus sign in front of it, given that we are talking about an asset. The calculation of other liabilities would not have a minus sign in front of it. Every time we approach the movement of a balance sheet item in our cash flow, we need to consider whether it is an asset or a liability, and apply this reasoning. The sum of these items gives us the company's cash flow from operating activities. Our next task is to obtain the firm's cash flow from investing activities. Cash flows can derive from gains or losses from investment instruments, such as stocks and bonds, and by amounts spent on investments in fixed assets, like property, plant, and equipment. The company we're looking at doesn't invest in financial securities. The only type of investing activity we'll find here is the amount spent on property, plant, and equipment. Often, companies call this item CapEx, deriving from capital expenditures. Property, plant, and equipment is an asset. Hence, we will have a minus sign in front of the difference between this year's PP&E and last year's PP&E. In addition, we should not forget that the firm expensed part of its property, plant, and equipment during the year under D&A. We have to consider that in order to obtain the full amount of CapEx. Think of it in the following way. We will calculate the difference between the amount we have in the balance sheet this year and the amount we had last year. However, a portion of this amount was already subtracted, so the firm spent more in order to obtain the current amount of PP&E. The last bit that we're missing is cash flow from financing activities. The company we're looking at increased its debt in the current year and paid dividends to its shareholders. These are the two items that must be considered here. Debt is a liability. It increased, so we got money coming in. This is a positive cash flow. Dividend payments are an item that decreases equity. We can subtract this year's equity from last year's equity and subtract net income to obtain the company's changes in equity and dividends. This gives us cash flow from financing activities, which in turn allows us to calculate the company's net cash flow. Let's check if we worked this correctly. The sum of beginning cash, which is the cash the company had at the end of 2015, and net cash flow should be equal to ending cash for 2016. This is the golden rule. As you can see, in our case, it worked, which means we've done a good job. This is how you can calculate a company's cash flow on your own. It's an invaluable skill for all corporate finance practitioners.